Welcome to the daily update, where I'll go over the action in the market for Friday, September 26th, and we'll see how things look for Monday, September 29th. All right, got a bit of a bounce. Now, the market could have tanked on the PCE report that came out, but it didn't. And so far, we're still holding above the 20 period moving average. After Thursday, we were looking like we're shifting more to negative conviction, but the 20 period exponential moving average held, and we closed back above that. And then the market went up on Friday. So now we're not really seeing much conviction in the short term at all. We're just kind of bouncing around at the time. Okay, so right at the open, we did have a higher open, and the futures reacted positively to the PCE report and the core PCE that came out. And we climbed above R1, 66.26, because we closed just at about 6,600 after Thursday. But we hit resistance at R2, 66.74. We declined back down below S1, but should actually be R1. We declined down below R1, but found support at the unchanged level. Then we rebounded back above R1. We got back up to R2, so it was like a roller coaster day, and we closed slightly below R2. We were up 0.59%. Now, this was below average with volume. Little bit of a concern when it comes to technical analysis. Typically, we've been seeing above average volume over the last pretty much. It didn't pick up right after Labor Day, but a few days after that, we started to see above average volume. And so in advance on below average volume, just something to keep tucked in the back of our mind. We typically want to see prices go up on an increase in volume. And we're still positive on all three time frames. As long as we're above that 20 period moving average, both the exponential and simple moving average, we are positive. And interest rates, kind of keeping an eye on that overall. And inflation, that's what the market was dealing with. And I'll go through those numbers. And of course, all the geopolitical things going on that the market's not paying all that much attention to. So we had another day with the mega caps and growth underperforming. And that's a little bit of a warning sign. The market is turning a little bit more defensive. And so the value stocks actually did a little bit better. The broader market did a little bit better. But the growth areas are in the mega caps, they are the stocks that really drive the indexes. And the economic reports that came out were stronger than expected. That's throwing a little bit of water onto this idea that the Fed's just automatically going to come in and cut rates. We've been seeing stronger than expected economic reports. And if that's the case, that throws the whole cutting rates kind of into question because we were seeing some weaker than expected reports and the market was liking that. Well, now that these reports are looking pretty solid, it's like, okay, is the Fed really going to come in and cut rates? And there should be concerns, not concerts. Well, it depends. Maybe you like it if there's a government shutdown and you have a concert because of that. This is a political ploy that happens. It happened last year. It'll happen. And they're going to shut down Mount Rushmore, and grandma's not going to get her Social Security check. It's all political posturing here. And then at the 11th hour, they usually come up with something. So we'll see. And now we are getting some more news when it applies to tariffs. So there are possible 100% tariffs on imported branded and generic pharmaceuticals announced by the Trump administration that will start on October 1st. So that would be in this upcoming week if the producer is not building a domestic presence. So they're just getting them from the outside. They're not setting up shop in the U.S. Okay, we're going to put a 100% tariff on you. Let's see if some kind of a deal comes from that. Heavy truck imports. Now, we make a lot of heavy trucks in the U.S., so why should we be getting them from the outside? That might have a 25% tariff. And then kitchen cabinets. Now, this is, world peace depends on kitchen cabinets and bathroom vanities. And associated products will be hit with 50% tariff. And see, this is to promote. It's like, okay, if you're going to sell us stuff, come here and start making the stuff here and give Americans jobs. And, or we're just going to jack up the price so the companies that are already making these things, they'll have lower prices and people will prefer that. That's the whole kind of maneuvering that's going on there. And then upholstered furniture, yes, it will come with a 30% tariff. All right. So we're getting in that area again. We're still seeing a warning signal with the S&P to VIX correlation. Now it's coming down a little bit. We'll see if it actually has spiked now. And more often than not, and I'll go through that chart and show you, that typically happens before we see some kind of a decline. And the parabolic SAR is negative. Now that's for the second day now, and that's what I consider to be a primary indicator. And we only have the stochastics chart, and that's the long short-term stochastic that is looking extreme positive there. The other ones are dropping. And then no real change. We're going to see if the last line here to the scenario with the Fed, likely rate cuts in October and December. I'll be going over that in the weekly video where I go through the probabilities as of Friday's close. And if we continue to get stronger than expected economic data, that could throw that scenario kind of make it so it's not automatic like the market was thinking. The dollar was down, and that did help, likely helped stocks to go up. Interest rates were up. We, again, since last week, we came down to that 4% level, hit it a couple of times, and now we're starting to go back up with the 10-year yield. We're at 4.19% right now. And sentiment, it ticked up a notch, but only to 53. So we're still neutral, but it's leaning a little bit more positive there. And we are positive with the trend, but it's weakening. We're still below the moving average, both in the short term and intermediate term, but we're above 20. So we are trending, and the green line is above the red line, so we're still positive there. And with the update, the bias is positive. I'm changing the momentum to mixed right now because it looked like we were shifting over and looking more negative. And then Friday, we're shifting over and looking a little bit more positive, and that's putting us kind of right in the middle where we're not seeing in the short term anyway what the momentum really is. That's why I'm calling it mixed. Okay, so we had personal income came in a little bit stronger than expected, up 0.4%. They thought it would come in up 0.3%. Last time it was up 0.4%. Spending also stronger than expected, up 0.6% on a month over month basis. Last time it was up 0.5%, and they expected it to actually drop down to 0.4%. Then the price index came in as expected, so that didn't really cause any concerns there. And the core PCE price, when you take out the things that you really need, like food and energy, it came in as expected. And so it was better than feared. Instead of, they thought there might be some surprise in this particular report that came out, and there really wasn't a surprise as it applies to the core PCE. So you annualize that out on a year-over-year basis, we're at 2.7%, where we had been at 2.6%. That's with the price index. But the core index is also up. Now, this is why I say the market could have freaked out over this. We were coming down to about 2.6% on an annual basis. Now we're bumping back up to 2.9. And it's like, uh-oh, if this had come in as expected or even lower than that, then that would feed more into, okay, the Fed's going to cut rates. But now that this is going back up, it's like, well, why do we need to cut rates? We're seeing these things actually climbing instead of declining. Consumer sentiment, a little bit weaker than expected at 55.1. They thought it would be 55.4. Last time it was at 55.4. And then the last reading that we had was at 58.2. But when you go back a year ago, we were at 70.1. So sentiment has dropped on an annual basis. So here is the personal income and spending, where we have spending, the blue line going up, and income actually going up. And so this part of the report looked pretty healthy. But the inflation, it's still having a tendency to tick up. It's below 3%, but it's not getting down to that 2% level. Actually, that would be clear down here, which is what the Fed really wants to have happen. And since it's been hanging around at this upper level now, between 2.5% and 3%, that's what they call sticky inflation. It's like sticking to the wall. It just won't move and start to come down. And month over month, personal spending did increase. And then here's the sentiment chart here. And this breaks it out into three different categories. The blue line, that's the total reading, and that was down. And then the present, that's the purple line, that also declined. And then looking out into the future, the yellow line, that also declined. And then here is where I have my own chart of the same economic report, but I put the 2-year treasury yield on that as well. And in a general sense, sentiment has been going down as interest rates have also been going down. But as interest rates were falling, they're going back up now, but as we were falling, you would think that would be more optimistic for folks, but it just hasn't translated into that. And you can also think, even though it's kind of beyond what this report tries to measure, but there's so many things going on right now that people are kind of distracted with everything that's happening. Okay, so then real investment advice comes out with the valuations based on forward and trailing operating earnings per share, where typically we'll see the red line. This is trailing earnings, and then the the forward estimates, and they continue to go up, and they're looking fairly healthy on this chart. And then a possible roadmap for an equity bubble. And again, I who knows how this is actually going to play out, but I went through the whole dot-com boom bust cycle, and stocks were just going to the moon, but they didn't have earnings behind them, where now these companies are much more solid. You were overvalued, but we've been overvalued for years. And as long as the earnings can match up with the stock prices and investors are willing to pay for expensive stocks, personally, I don't see that as a bubble, but a lot of people do, and that's what they're trying to bring out here, where you match up 1996 through 2001, that was the dot-com boom, and then you go from January 2023 up to right now, and how they're kind of matching with each other along the way here. That's with the S&P. Then you have the Nasdaq looking at that same time period and how they're kind of matching up with each other. Now, if we do continue along the same path, you notice what happens after this. We continue to go up. It means it's not finished, at least as of yet. And then we have this blow off top. Now, if we do get some kind of a really big move to the upside, yeah, we'll just evaluate things, and it might become too exuberant at that time. But to try to compare these, and you can see the similarity between the price patterns along the way here, and there's something to be said for that. But it it, it doesn't mean it's going to repeat exactly the same way. We just use this as a guide. All right, concentration on market cap and earnings, and the 10 largest companies. We get this chart quite often. It's 40% of the market cap, 30% of the earnings. I think this is the same chart we had a few days ago. Without tech, the U.S. economy would have been close to a recession. Okay, that's why tech is the big growth area. When you take that out of the equation, yeah, the rest of the stocks in the S&P have been lagging behind. That's why we focus more on the really big ones, and whatever they're doing has more of an impact on the index. And then preliminary survey results looking at the following assets and using a scale of 0 to 10, where 0 means no bubble, 10 means extreme bubble. Please tell us where you think assets are currently at. Tech, 7.3 out of 10. Magnificent 7, 7.6. Non-tech, see, they're lagging behind. Not necessarily in a bubble. European equities, which have been lagging recently, and then Europe, Asian equities as well. Bitcoin, a little bit higher on the scale here. European credit spreads, and then U.S. credit spreads down here. So, yeah, it's like, okay, a lot of folks think we're in a bubble. Doesn't necessarily mean we are, but sentiment also drives the market as well for how people are feeling about things. Okay, government shutdown. All right, here we go again with this political game that's going on. Prediction markets increasingly expect a shutdown in 2025. All right, we'll just have to see how it plays out, and they'll point fingers at each other and blame each other for what's going on. That's politics. And then the Atlanta Fed's GDP Now model estimates growth would jump to 3.8 from 3.3% on September 17th, which is before the report actually came out. And so they are looking a little bit more optimistic as far as GDP. And then the economic surprise index, it has surged. Will the US dollar follow? These tend to go more hand in hand with each other. Are we going to see a pickup here? Now, this is the spot index, and that's pretty much what I follow. That's what the price is right now, not necessarily a futures contract. What's the price going to be 3 months, 6 months, 9 months down the road from now, where they tend to track along with each other. So we see the surprise index actually going up here. Is the dollar going to do that as well? And that could end up pressuring stocks. All right, and Bitcoin. This is a major level for Bitcoin. And I just do this because there's a pretty strong correlation between Bitcoin in particular, since it's the biggest, and the NASDAQ 100. And the NASDAQ 100 stocks are also in the S&P. So that's why we follow all of these things. But I just kind of more of an observer of this. And then this is using a volume weighted moving average. And I use those. I haven't been lately because they've been setting up some kind of support level. And we keep setting recent all-time highs in the S&P. So there's no need to look at that chart. From the April lows, and former resistance earlier this year. So these are just projecting out. So they've kind of come up with this range right in here, which is about where Bitcoin is at. Is it going to hold and bounce up off of that? That might help the Nasdaq 100 if it goes up, which would also help the S&P. Or if we break down below this, what they're calling support here from previous levels, that might put some more pressure on the Nasdaq 100, which could also pressure the S&P 500. Okay, and then our chart intraday here, where we had to have it was kind of a copy of what happened on Thursday, only in reverse, where we had a gap lower and then we saw buying coming in to the market. Well, here we had a gap higher and then we saw selling coming in. We did stay above the unchanged level. That works as a support level on an up day. Then we got real choppy for a while before finally breaking back above R1. We did get back up to R2, but then closed a little bit below that. Okay, and then things are pretty quiet as they settle down for the weekend. And we're seeing value outperforming growth here. Now they're both going up slightly, so that's positive, but we would like to see the blue line above the red line. This is not showing that much improvement. We're still below the two shorter term moving averages here when we look at the intraday chart of growth to value for the S&P. So growth was up less, even though it was up on Friday for the large caps. It was up a little bit more for the mid caps, but less for the small caps. So now we're back to seeing not a really positive looking move lately with the growth to value ratio for the small caps. We would like to see this go up and match what we've been seeing in the index, and we're not really seeing that right now. And after breaking out a few days ago, now we're falling back with the mid-cap growth to value ratio. We're still under the 50-period moving average with S&P growth to value, but longer term, this is still in an uptrend. But this is going back to the beginning of August. This is when we saw the market becoming a little bit more defensive, and now it appears like it's doing that a little bit more again. And we're coming back down into the top end of the rainbow with this growth to value ratio. Still looking good here though. And it's not so much, well, we were up with discretionary. Tesla had a good day on Friday, but we've been really coming down with staples, and that's been helping the discretionary to staples ratio really improve. And we're not trending. We're still below the moving average here in the short term, and we're going down with the ADX, but we're still trending since we're above 20. But the green line is above the red line, so we're positive that way as well. Seeing a very similar thing here, below the moving average, so it's a weakening trend, but positive with the green line above the red line. And we did drop to below average with volume in Friday's session. And then here's the gamma chart to look at exposure to see if we can pick out any areas of support and resistance. We closed around the 6644 area. I round this up here. Just a few days ago, we were really watching the 6700 level. Now we're coming back down a little bit here. The area to watch would be the 6583 roughly, and that's still below current prices here. But if we start to break below that, break below that, you see a lot of green right here. So the gamma is leaning more that the market's going to go up. If we keep going down with the S&P, we might get into this red area, which means the market is turning more negative. And we did decline with the VIX. We're really not seeing much fear when we look at the VIX, both with the line chart and the bar chart. Wondering if we're going to see some seasonality. Just hasn't really kicked in, at least to this point. And we did drop down here because we had the update with the VIX of the VIX, both with the bar chart and line chart. This is where we're still getting a warning. We're still above this dashed line. Now we came up above the dashed line and we're not totally sure, but we could have spiked and now we're starting to come down. We don't know if this is going to turn and go back up. But for right now, when we get up into this nervous area here, go back and look, and you can see this is a longer term chart, so it might be a little hard to see. But a lot of times, this is what happened before we saw a decline, at least in the short term. Now, there were times when it didn't really mean all that much, and it didn't mean that something was going to happen right away. There might be a bit of a delay with this. But this is picking up fear that we're not seeing in our other sentiment gauges. And so we decreased with this fear gauge, and we also decreased with this other fear gauge with the up day. We did decline a little bit with the daily equity put call chart. Now we did bounce up, but we're still below this red line with the 5-day chart of the equity put call ratio. And this is quite often when we see some kind of a top here. We'll have to see if that continues because generally when this is going down, that's treated as more positive for the market. This is a longer term look just to give you some other times we drop below this extreme reading, and then you can try to match it up with what was happening with the market at that time. And we're also still declining here, so that's positive with the 10-day chart. Now, if this continues to go down, we're going to get kind of to an extreme reading that marked more of a significant top, but we're not there yet. And we did come down a little bit here, but we're getting a pretty high reading with the volatility risk premium. So we're not seeing this in the VIX with the increase in fear, but we're seeing it with the S&P to VIX correlation, and we're seeing it in this chart here, the volatility risk premium. So we did go back up here with the advanced decline line based on price and volume. So, and we're actually possibly breaking out to a new high, where volume has been holding up better than price for the S&P. We're back above the midpoint with the short and intermediate term advanced decline ratio, and we're right about here, just barely negative here with the advanced decline oscillator over the last 10 periods. And we did see some new highs here, but overall, we're still declining with the 5-day moving average chart, and we're flattening out with the 10-day moving average chart. And we're still positive in the bigger picture with accumulation distribution above the moving average. We did turn up with the boom indicator, which is shorter term, but we haven't crossed back above the moving average yet. And we are still declining and looking negative with the Chaikin money flow. And we did turn back to positive here with the Chaikin oscillator. So we're getting a mixed bag again with our smart money indicators as this came back up and started to cross above its moving average. And we're still positive with the vortex, even though the green line has been coming down. On Friday, the red line actually went down. So the green line's above the red line. That is positive. And we got back above the moving average here with the S&P. We're back up about to the moving average with the NYC common stock. We did improve with the mid caps and small caps, but they're still below the moving average. And we're just barely positive here with those stocks in the S&P above their 20 period moving averages, just barely back above 50, where it had been hanging out mostly under 50. So this is turning back a little more positive. And the 50 period moving average study, after coming down to this 50 level, did see an improvement, a bit of an improvement with the 100 and 200 period moving average study there. So we're still wondering if this dashed line, which was a pivot point for September, that's about where we topped out with the S&P, and that's when we started to come down. Is this still going to play a role in being overhead resistance? And we dropped to below average with volume. So a little bit of an improvement, slightly above 50 with the 20 period moving average study. The 50 period moving average study improved, as did the 200. And all three of these are above 50. That's still leaning more positive. 50 is the line between positive and negative. And after being extreme negative with the Stochk RSI, we had enough of an upward move to get that out of extreme territory. But we're still kind of in no man's land here, but above the midpoint with the Williams percent R, still bouncing off the midpoint with the CCI 14 and bouncing above the midpoint with the CCI 20. So we're going back up, but we're not extreme with the short-term stochastic. We're still declining with the intermediate short term. We're still declining below the moving average and getting an extreme reading here in the long short term. This is why it's still on the list, is because of this bottom chart. And we bounced a little bit up here, but still below the midpoint with the force index. We're still seeing a little bit of vulnerability with the short-term trend. Even though we had an up day, we didn't get back above the double or triple exponential moving averages. So that's kind of causing these to slow down a little bit here. But we did bounce off of the 20 period exponential moving average on Thursday, and so far we're staying above that. And that's pretty much what we've seen going back to coming out of the April lows. We spent some time below it, but quickly got back above it. Is this going to be enough of a support level to keep us going back up? That's what we're looking at now. And we're back up just barely into the +2 channel with the standard deviations chart. We're back above zero with the balance of power. That's looking a little more positive. We're still negative though, or at least less positive with the lighter blue bars with the go, no go system. And back above the midpoint, we came down to the midpoint, bounced back up on Thursday. We're above the midpoint again with the highest high, lowest low value chart. On day 103 with this uptrend going back to the beginning of May, according to the Landry Light System. On day 97, their uptrend started a little bit later in May, there with the proper order system. And after seeing a darker blue bar here with the TTM squeeze with the upward move, we've turned back to a lighter blue bar. So that's still looking positive there. Still barely above zero here with the ease of movement. The Arun is actually declining a little bit now, but we're still positive since we're above zero with the oscillator. The buyers are decreasing, and we're seeing the sellers pretty much non-existent right now. That's why we're getting a positive reading with the Arun oscillator. And just barely above zero here with the McClellan oscillator for the S&P. We have been concerned that we're seeing lower highs as the S&P has been going up, and it looked like it was starting to play out that way. Well, this is still a lower high in here, but we could negate all of that if we see more strength in the McClellan oscillator come in and start to take out some of these previous highs. So we're barely going up based on price, and now we're starting to turn up based on volume. Where after Thursday, we were turning down on price and volume. And we did improve with the NYSE McClellan oscillator, but we're still below zero. So we're still going down with the summation index based on price and volume for the NYSE summation index. And now we're looking positive. Where after Thursday, we were negative with the swirling trading oscillator now going up based on price and volume. And we're still rolling over. It takes longer for the momentum oscillators to actually show some conviction. So we're still coming down to the moving average with the PMO. We're still looking weaker here when we break it out based on price. We're still below a declining moving average, but we're back up to a rising moving average here when we look at this based on volume. So we're just a little bit below 50 with the PMOs that are rising. We're also ticking up a little bit, but below 50 with the buy signals, and we're starting to try to turn up a little bit with the PMOs that are above zero. Neutral with the Elder's Impulse System, negative with the Parabolic SAR since the dots are on top. And now we're coming back down to the moving average here with the slope oscillator, but we haven't crossed below the moving average yet. And we're coming back down to the moving average with the MACD. So in the short and intermediate term, we're seeing some vulnerability where we are still positive in the long term with the TRIX and KST oscillators and coming down to the moving average, but haven't quite crossed below it yet with the Copic curve. We did tick up, but we're not extreme or very extreme here with the Sean trend meter. And we're still above 50 with the money flow. We did tick up above 50 with the ultimate oscillator, still above the moving average with on balance volume, still above 50 with the intermediate and short-term RSI charts. And we did break down below the short-term 10 period trend here. We bounced off the 20 period exponential moving average, and we're getting right back up to the short-term trend again. It would be even more positive if we could get back up above this green line and then stay above it. And we're still seeing a couple of days here below the red line and the blue line with the intermediate term trend, but the lines are still going up for right now. It hasn't really switched over negative, and we're still above all the moving averages, and all the moving averages continue to go up. And after we drop down below the 10% level with the distance to the 200-day simple moving average, we're now back above it, 10.45%. This is what we want to watch for here. Usually we see more substantial declines if we get 10% or above. In fact, I have another chart here. 200-day and the moving average with the S&P. It's helpful to look at the S&P to compare it to its 200-day moving average. We're right about at 10, and that's what I've been following now. But that's not when we've seen local tops. We've generally seen local tops, meaning short-term local, is where we get between 13 and 15%. That's what I've been saying. There's no magic percentage here. It could be 12, 13, 14, 15. We didn't get up to that at this point right now. So there's other charts that are showing this information as well. Tom Lee, doesn't he play drums for Motley Crue? All right. And then we are still declining here overall with the bullish percent index. We bounced up, but we didn't get back above the moving average. And we ticked up a little bit here with the NYSE bullish percent index, and we were flat with the NASDAQ 100 bullish percent index. Now we did come down to this little mini rainbow, which is a 20 period simple moving average of the open, high, low, close. We bounced up off of this, and so far we're still above that. And as long as we stay above it, that'll be more positive. And this is the weekly chart where we ended up being down 0.31% for the week, but not enough to get back down to this R1 level. And still the longer term pattern, you can see higher highs, higher lows on weekly bars. That's still looking pretty healthy. That hasn't been violated yet as far as the integrity of this chart, and that's longer term. We're still at the upper end of the trend channel going back to 2009 with the S&P 500 and have a doji because we were positive, then we started to turn more negative. Now we see a candle here that shows more indecisiveness. It was starting to see more negative conviction. Now with the update, it's like, well, I don't know what to do right now. But we're now pointing back up with the Kegi chart, so that is positive. The Renko chart is still positive, but we're still looking a little bit more negative with the three-line break chart. Long term, still holding out for pretty well here with the 150 and 200 moving averages. And we're back to positive. We had enough of an upward move with the short term mid caps. So all of the different indexes are back to looking positive. We're still in a short term uptrend with the dollar where we're negative in the intermediate and long term. And all of the indexes ended up being up with utilities being up the most. And discretionary had a good day. That was mostly Tesla. And then at the bottom, staples were up, but they were up less. But then communication and tech, the other two big growth areas, they were up, but didn't really show a lot of conviction. So we had the Dow crossing above 46,000, the Nasdaq above 22.4, but then it went down below 22.3. So not a lot of triggers other than round numbers for the other indexes. So we do see a little bit of kind of sickly looking green here with both the Google stocks here. Apple was down, Microsoft was up, Nvidia was virtually unchanged. We had Oracle still dropping down a little bit. But then we look at discretionary, Tesla up over 4%. And that really is what helped. And Amazon was up 0.75%. So that helped the discretionary sector. Financial sector did see an improvement overall there. But when you have Meta down a little bit, Google up a little bit, didn't really help communication all that much. So the Dow still below this pivot point here. It came right up to that level, got above it intraday, but then closed down below it. So far, we've been not able to get back above this overhead resistance. And we've gone from negative to neutral with the diamonds, with the Elder's Impulse system. We're right back up to this pivot point now with the NASDAQ. Now, it didn't seem to matter before. We blew through that pretty quickly. Is it going to matter this time? And we're still neutral with the NASDAQ with the Elder's Impulse system. We're not quite back up to this pivot point here with the NASDAQ 100, and we're still neutral with the Qs looking at the Elder's Impulse system. Now, we're showing some weakness still with the PPO. That's what I use to measure the momentum of the NASDAQ 100. It's still positive. It hasn't crossed below its moving average, but we're going to need to see some follow through upside to avoid this from actually crossing over negative. Still positive here with the weekly chart of the NASDAQ, and it ended up being down 0.5% for the week and just kind of chopping around, not really going anywhere right now with the small caps, even though they were up over 1% with the S&P 600. They were up less than 1% with the Russell 2000 small caps. So maybe has this gap been filled? Is that what wanted to happen? We gap down here. We fill the gap. Is that going to mean we go back to the upside? That's what we've seen lately. But a lot of times we'll come back, fill the gap before we start to really go down from here. And we're still above 50 with the RSI, but we're seeing the momentum as measured by the MACD turning negative. And we've gone from negative to neutral with the Elder's Impulse system for the small caps. We did bounce back up off of the 50-day moving average with the mid caps. That was enough to turn it back positive. And we've gone from negative to positive with the mid caps, also filling in this gap and then some. The Wilshire, it was up, but not back to an all-time high. We were also up with the total U.S. stock ETF. And the financial sector was up almost 0.75% above its 50-day moving average, but it's still continuing to underperform the S&P. And the FANG index, it was up also, again, 0.44%, not any real strength there. So Apple was down more than 0.5%. We had Amazon up 0.75%. Microsoft was up 0.87%, still hanging out at its 50-day moving average. We did bounce up 0.33% with Google, and we're at the 50-period moving average with Meta. Nvidia was up. It's still dealing with its 50-day moving average. Tesla rose up over 4%. That was kind of the star in Friday's session. Netflix also still hanging around its 50-day moving average, which is declining. And still seeing a bit of a drop off here with the correlation between US and world stocks, and a little bit of a downturn here with the longer term correlation. In the mid 60s right now with oil, and we have seen a bit of a bounce, even though it was down on Friday with the dollar. And then we look at bonds. And you can see how we came down here and tested this 4% level a couple of times, and now we've been going up, and it's pretty much been going up since the Fed came in and cut rates, which is the opposite of what you would logically think would happen. The Fed cuts rates, so don't you think the 10-year yield would go down? No, that's not what's happening right now. And we're continuing to go down with the 10-year based on price. So we're still looking okay here, but not really seeing a lot of conviction in the short term with the Q to S&P ratio coming back up to the moving average with discretionary to the S&P coming back down, but still above the moving average when we compare large cap growth to value. So when the large caps were below the moving average, down to the moving average of the mid caps, after that had really been looking strong, and we're falling further below the moving average with the small caps. All right, so we're positive on all time frames and we're above support, but right now we don't really have any conviction. We were positive, and then we saw some weakness starting to come in, and that was turning us more negative. And then with Friday's update, that's kind of kicked us back into no man's land in the short term. We will get pending home sales on Monday, not really a market driving report. And then anything geopolitical. And then who knows what crazy things could happen over the weekend. So here is the economic calendar for the upcoming week. Now we're going to get some important data coming out, but not really market moving. We'll get some housing data here. But then the big one will be on Wednesday, ISM manufacturing. That's a really big one. Of course, every week we get initial and continuing claims. And then the really big day is going to be Friday, the employment situation report, and the ISM services. Those are both, I mean, separate, they're a big deal. Let's see how Friday acts when they're both coming out on the same day. Here's also a look at the upcoming week with the economic calendar. Seasonally, though, not really much of an edge for September 29th. We're not no longer in options expiration or the week after options expiration. So we're neutral to positive with the Dow and S&P, where we're neutral to negative with the Nasdaq. So really no lean there. And we still have a couple of days left in September where sometimes we see a bit of a bounce, sometimes we see some weakness here. Yeah. This also shows how September is negative. Another chart showing how September is negative. Second half of September is the worst performing half month going back to 1950. And this also shows some weakness that really hasn't materialized substantially to this point. This also shows how September typically ends up being weaker. So, looking at our smart money indicators, we're positive in the bigger picture with accumulation distribution, and we advance with the boom indicator, but we're still below the moving average. Where the chicken money flow is still negative, and now the chicken oscillator is positive. McClellan oscillator and summation index for the NYSE. It's still negative. It bounced up, but it hasn't crossed back above zero. Parabolic SAR is negative, as is the bullish percent index. Even though it bounced, it never got back above its moving average. So on the positive side, our growth to value ratios, they're discretionary to staples, are still looking okay in the bigger picture. Just shorter term, we've been seeing some concerns. The oscillators showing some weakness there, but still hanging on to being positive. And we're just barely above zero with the McClellan oscillator for the S&P, so that might help the summation index as well. Swellman trading oscillator now pointing up based on price and volume. And the bullish percent indexes, because they're above 50 for the NASDAQ 100 and the NYSE, those are still positive. Ease of movement, money flow, ultimate oscillator are positive, as is the vortex. And the momentum showing some weakness, but still positive for the NASDAQ 100. Financial sector, but it continues to underperform the S&P. And then the long-term special K chart, which I'll hit again in the weekend videos. All right, here are the pivot points for Monday's session. So our conclusion, we're positive and we're above support. But in the short term, we're not seeing any real conviction right now. We were starting to lean more negative with the update. Now we're back to not really seeing much conviction at all. We're still watching those 20-period moving averages. That was important on Thursday. Didn't come into play on Friday. We'll see if it comes up in the upcoming week. Intermediate term, we're seeing some weakness and some improvements. How's that? Now, when you look at the index itself, we're holding up better. But when you break it down based on price and volume, it's actually looking a little bit better. But internally, inside of the S&P, that we're seeing some improvement there, but we're also seeing some weakness as well. Then long term, I had to put this back on the list again because we're more than 10% above the 200-day simple moving average, but we are still positive. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.